Let's take this case study to understand cost of capital computation. Stopgo Limited, an all-equity financed company, is considering repurchase of $20 million equity and to replace it with 15% debentures of the same amount. Current market value of the company is $114 million and its cost of capital is 20%. So remember this, it's an all-equity financed company. Its earning before interest and taxes, that is EBIT, are expected to remain constant in future. Its entire earnings are distributed as dividend. You have to calculate the impact on the following on account of change in the capital structure as per Modigliani and Miller. So you have to see what is the impact on market value of the company when they do this repurchase of equity and replace it with a debenture. You should also look into the impact which is creating on cost of capital, because present cost of capital is 20%. You have to see what is the cost when they go for this, and should also look at what is the cost of equity. See, at present, when it is an all equity financed company, the cost of capital and cost of equity is 20%. But when they move to that, okay, so it can be different, and there can be some changes also as we progress. Let's understand. So we are given one information, that is market value. Okay, so I'm going to use that. We are given market value of equity. Using the market value of equity and using an inference, that is cost of capital is equal to cost of equity, because this firm has no other debt, so cost of equity will be equal to cost of capital. So KE is equal to KO. So using these two information, we can easily find out what is the net income for equity shareholders. So we'll write that net income for equity shareholder divided by KE, which is equal to KO. The overall cost of capital is 20%, so we'll write 0.20, and that's equal to market value of equity, which is 114 million. Now simply do this cross multiplication. You get to know what is the net income to equity shareholders, which is $22.8 million. And how I got this? 114 into 0.2. And this figure will be generally after tax. So we'll make an assumption here, because the question does not talk about taxes. So we are making assumption. Assumption is tax is at the rate of 30%. So what does that mean? This 22.8 million is after tax of 30%. So this is equivalent to 70%. And why this information is going to help me? Because this is earnings after tax, or we say profit after tax. And if you want to go to profit before tax, you should look at 100% of it. And how do you know the 100%? Take this $22.8 million divided by 70%, so you get 100%, right? We're going to do that. That is, EBIT is equal to PAT of $22.8 million divided by 0.7, you get $32.57 million, which is nothing but what? Earnings before tax. In this case, we can even attribute it as EBIT, earnings before interest and tax, because there is no debt. So this $32.57 is the EBIT of this company. This information is very, very vital, because we are going to use this information for comparison purpose, because this is their EBIT. So you can use this EBIT and see what is the kind of impact it is going to have on the profits by categorizing it as the profits for equity shareholders when they had equity, when they have debentures. Okay, so let's do that. Yeah, look at here. All equity firm, and there is a combination. There is a debt and equity. Okay, there is a debt and equity, I would say. EBIT in both cases, it is 32.57. Now we have to deduct interest. And what is the capital they are raising? 20 million. At what rate? 15%, right? So you have to take 200 lakhs, or we can also say like 20 million. 20 million at the rate of 15%. So you get let's say 3 million, and that will not get applied here because it's all equity, but here there's a debt of 20 million which they are raising at the rate of 15%. So this 3 is a deduction item, and if you deduct that, you get earnings before taxes. So in this case it's same 32.57, whereas here it is 32.57 minus 3, it is 29.57. Now from this EBT you can deduct the tax of 30%. So let's tax at 30%. 32.57 into 30% is 9.77. 29.57 into 30% is 8.87. If you deduct that, you get earnings after tax, which is nothing but the income available to equity shareholders. This 22.8 is what with which we started. Okay, using this figure only we derived this. Fine. And here 29.87 minus 8.87, what you get is 20.7. This information is very, very important for us. Let's proceed. Okay, now how do you find the market value of the levered firm? Because earlier they were unlevered, now they have moved as levered firm. So what you can do is you can take the value of unlevered firm, which is 114, and then with that you can add the tax advantage which you have gained. So what is the market value of unlevered firm, which is 114, and by raising a debt of 20 million, okay, what is the tax advantage they are going to get? On the 30% only they are going to get the tax advantage, right? So 20 million into 30%. So it is 114 plus 20 into 30% is 6 million. So 120 million. So this is the market value of levered firm. Whereas the market value of unlevered firm was 114 million. Okay. So the impact is that market value of the company has increased by $6 million. Right. Next, we'll look at the impact on cost of equity. How can you find the cost of equity? You have to take net income available to equity shareholders divided by equity value. What is the net income available to equity shareholders? In this case, it is 20.7 divided by equity value. Equity is 120 minus 120 is the value from the deduct the debt of 20 million. So it's basically 100 million. Okay. So 20.7 divided by, okay, see, look at the impact. You take the overall value as 120 and from that you are deducting the debt of 20. So you get only 100. So 20.7 divided by 100 into 100. So what you are getting as cost of equity? Cost of equity is equal to 20.7%. So earlier it was 20%, right? So what is the conclusion? Earlier the cost of equity was 20%. Now that has increased. And let us also see what is the impact it has on overall cost of capital, because you have to give weightage for the debt that has come into the picture. So we'll have the structure like this. Components: equity. Equity, what is the amount? 100. That's what we derived. And cost of capital. Cost of capital, yes, we have calculated now 20.7. This weightage I'll come little later. What about the debt? It is 20 million. And what is the cost? We know 15% is the cost of debt. So 15%. So it's basically KD multiplied by 1 minus T, we say. So multiplied by 1 minus tax rate, which is 30%, 0.3. 1 minus 0.3 is 0.7. 15% into 0.7 is equal to 10.5. Okay, now we'll take the total of this. 100 plus 20, you get 120. So what is the proportion? 100 divided by 120. That will give the weight, right? So 100 divided by 120, you get 83.33%. And 20 divided by 120, you get 16.67%. So now if you want to know what is the weighted cost of capital, take this cost of capital, multiply with weight. 20.7 into 83.33% will give you 17.25, and 10.5 into 16.67% will give you 1.75. Add these two, what you get is 19%. So what happened to your cost of capital? Cost of capital has come down. Okay. So the impact is that weighted average cost of capital has fallen from 20%, it has come down to 19%. And why? This is mainly because of the tax relief on debt interest payment. Okay. And what happened to cost of equity? It actually increased, like, because it increased to 20.7. Earlier it was only 20%, now it is 20.7%, so 0.7% increase. And why this has happened? This has happened because of presence of financial risk. So we calculated the cost of equity, we calculated overall cost of capital through a tabular method and a formula method. We can also find them in an alternative way. The cost of capital, cost of equity can also be calculated with the help of formulas. Of course, there will be no change in the final answers. Cost of capital can be calculated like this. KO is equal to KU of U multiplied by 1 minus TL. Here, KU stands for cost of equity in an unlevered firm, and T stands for the tax rate, and L stands for this proportion, basically debt divided by the overall value. Okay, so look at the formula now. KO is equal to the cost of equity in an unlevered firm is 0.20, okay, not 0.02, it is 0.20 multiplied by 1 minus the debt is $20 million and overall is $120 million. That is debt plus equity. Okay, and this should be multiplied with tax rate 0.3, and you see what you get here is 0.19 or say 19%. This is your cost of capital. Okay. Next, you can also find the cost of equity using this formula, KE of U plus KE of U minus KD, and this is multiplied with debt into 1 minus T by equity. Let's see. Here KE of U is cost of equity in an unlevered company, KD is cost of debt, T stands for tax rate. So we'll write KE is equal to 0.20, of course we know, plus KE of U minus KD, that is 0.20 minus KD, that is cost of debenture is 15%, 0.15, and we'll multiply this with debt, which is $20 million, multiplied by 1 minus T, 1 minus 0.3, divided by equity of $100 million, and if you calculate, you get 20.7%. Either way, we are landing in the same solution.